Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today.
Okay, so today's chart is the equal weighted S&P 500 versus the cap weighted S&P 500. I want to start just very briefly by explaining the differences between these two because it's confusing for a number of people if you're not familiar with indexes and index construction. So a traditional index, most indexes that you know, including the S&P 500 probably is the most obvious example, they are market cap weighted, meaning the larger the company in terms of its market capitalization, the price times the shares outstanding. So basically how much equity have they capitalized, right? How much is out there? The larger that number, the larger the market cap, the bigger the weight. So it means big mega cap names like Apple and others have an oversized weight in an index because their movements will be magnified, whereas the movements of mid cap or small cap companies will be marginalized, right? There'll be very limited impact on an index. Now, this creates some interesting phenomena because in something like the XLY, which is the consumer discretionary ETF, because it's cap weighted, a single stock Amazon has over 25% weight in that sector ETF. So if Amazon is up or down meaningfully during the day, that will cause the XLY to be up or down meaningfully based purely on the movement of Amazon, not on the movement of the sort of the average consumer discretionary stock. Other indexes like the Dow Jones Industrial Average are actually price weighted. So they look at prices. So the higher the price, the more that it's weighted. And that means Apple and its split just recently caused a change in the weightings of the Dow because it's a much lower price. And as a result, instead of being the top weighted name in the index, it's now sort of in the middle of those 30 stocks. Third way we can weight an index is equal weighted, meaning basically just like an equal weighted measure, a simple average. Instead of weighting the members by a certain factor like market cap or price, you're weighting them all individually. So each stock gets a weight of one, and you look at their performance relative to one another. So the RSP is an equal weighted S&P 500 ETF. So it's an ETF driven by the equal weighted performance of all of the members of the S&P 500. The SPY, the regular S&P 500 sectors or Spider ETF, is literally cap weighted. So it's the same weightings as you see in the S&P 500. So what we're doing is we're looking at a ratio of the equal weighted S&P versus the cap weighted S&P. So if this line is going up, like you see here, mid-May to early June, that tells you that the cap weighted version is underperforming or the equal weighted version is outperforming. And what that means is the smaller members of the S&P 500 are doing better than the larger numbers by the fact that that index, that equal weighted index, is doing better than the cap weighted index. If this line is going down, like you see for the first half of the chart going into the market low in March, that means the equal weighted index is underperforming the cap weighted index, meaning the smaller companies within the S&P 500 are underperforming the largest companies because the equal weighted version is underperforming the cap weighted version. So generally, this is a similar ratio to if you look at small cap versus large cap, it will tend to look very similar to this. So like the IWM versus the SPY, because you're doing a similar type of analysis. You're basically taking the mega cap weighting out, taking the impact of mega caps out of the way, and doing more of an analysis of what's happening. So the way to think of these indexes, the cap weighted index like the S&P is really a measure of the largest companies and how they're performing relative to others. This equal weighted index, the RSP, is basically telling you more what is the average stock doing because it takes that sort of that overweight of the mega caps out. So let's look at what's happened recently. This ratio bottomed out in March, and this is right at the March low. So going into that low, the equal weighted version was underperforming. Mega cap stocks were doing very well. We're outperforming the smaller names within the index. This is as the market topped and went into the market low. But it wasn't just then. This actually was happening going into the market top, where you had the equal weighted index underperforming. So this was one of the measures of breadth that was similar to the advanced decline lines starting to roll over. If you look at the advanced decline lines on the New York Stock Exchange or mid caps or small caps, you'll see they all rolled over in January to February, while the S&P breadth actually remained pretty positive, and that lines up with what we see here. From the March market low to the market peak in June, this ratio reversed and the equal weighted version was outperforming. So this told you that it was less about the leadership of mega caps and more about a broad advance out of the market lows in March. Then the month after that June peak, the ratio reversed again and went back lower, almost going to a new low for the year 2020, which again told you it was once again mega caps redefining, retaking control of the market advance. And now what we've seen in the last week is this ratio has indeed gone to a new 12-month plus low. And what that signifies is that it is once again a narrow group of mega cap stocks that are pushing the market higher. And so what's interesting here is that pretty much any breadth measure I could come up with, equal weighted stocks versus market cap weighted stocks, which is what you're looking at here, small cap versus large cap, cumulative advanced decline lines, the McClellan oscillator, and I could go on, they are all rolling over and all going negative. This is happening in the face of the S&P continuing to make higher highs. And so what this tells you is this is pretty classic for a bull market top playbook. The market will continue higher. It'll be driven by a smaller number of names as people get defensive and get into the big, safe mega cap stocks. The average stock is already rolling over, and you will see things like mid caps and small caps depreciate. You will see the breadth lines roll over. You will see equal weighted indexes underperform. All of that tends to happen just before the market tops. Then the very last thing to roll over would be those big mega cap names like Apple, Microsoft, Google, Alphabet, others that have been driving so strong to the upside. Those will be the very last ones as people start to take those bets off and get out of equities altogether. That is the piece of the puzzle that has not happened yet. But what this chart is telling you is that the average stock is underperforming the mega cap stocks. This is indicating a flight away from speculative, high beta offensive, traditional offensive plays, and money, if it's flowing into equities, is going into the big defensive mega caps. The challenge for investors right now is that, as we've seen from the last couple weeks, if not the last couple months, is that the market can continue to go higher and higher, even given this weakening breadth condition. But again, for me, I think about price first, then breadth, then sentiment in that priority order. Price is number one. Prices overall, the markets are still going higher, so that has to be the trend that I follow. But breadth, which is a secondary confirmation of what you see with price, is certainly starting to fail by any measure that I can look at, suggesting we are entering the beginning of this market topping phase. From everyone here at Market Misbehavior, I hope you stay safe. Thanks so much.